Hello, everyone. Thank you for joining us for the Financial Tides podcast. Today, we are going to be talking about college planning and how it affects the financial picture and what we can do to strategize and help you guys by passing some information. Financial Tides is all about passing information along to you guys to help rise up the tide for you guys to get as much information as possible and help secure your financial future. So we'll kick off today. This is my co-host John by talking about 529 plans. So John, give us a little bit about what 529 plans are and how they're used.
Sure, Taylor. Thank you. And thank you everyone for joining. We used to call the 529 plan college savings account, but that's changed a little bit under recent regulations. So for now, we'll just call it 529 plan. And there are two basic types. There's the prepaid tuition plan. If you know where your kid's going to go, what university, and it's a participating university, you can lock in a tuition amount in the future today, in today's dollars, and fund that plan. So that's the prepaid tuition plan. Not very common. Most people don't want to be pigeonholed into trying to apply to a certain school down the road. If that school's still going to be a good school, if they're going to, it's going to be something the kids are eligible for. So that's the prepaid plan. The education savings account is the mutual fund version of it, where you fund your own separate account with gift money, donation money for the kids, birthday money, and you just save and you invest over time and you use it anywhere you want. So that's the traditional education savings plan. And I think I pretty much covered it, Taylor. Are we going to cover the fact that the Secure Act opens it up to?
Yeah, I think before you dive into that, I think there's just one more account type that we see get asked often when it comes to planning for the future, which is the universal transfer to minors accounts. They're not a qualified plan per se, like a 529 type plan, but I think it's worth mentioning in here that universal transfer to minors accounts get used often as well. The only issue that we have with them typically is that we see the age of majority come into play more often, where if the kid gets to the age of 21, 25, it varies from state to state, that they are then the ones that have the funds. They can do whatever they want with them. It's not required to be used for education. So it's worth mentioning that account as well before we go into some of the portability of plans. So John, do you want to cover the portability prior to Secure Act 2.0, and then I'll hit on 2.0?
Sure. Before 2.0, the options were my kid uses the money for college, or we can move it to another beneficiary. So, Taylor's the middle of three children who all went to school. But if one of them didn't go to school, I could have taken their 529 money and moved it to the other two kids. Another option is to say, all right, I don't want to punish the kid who didn't go to school. So instead of giving it to their siblings, I'll save that for another generation. And if they have kids, put it in their kid's name. So now it's got an extra 30 years to grow. And so you're not punishing the kid that didn't go to school. You're taking the money that was earmarked for his school and giving it to his kids, which can be quite powerful over the longevity cycle.
Yeah, and I think that was a great thing to have back in the day because you didn't know whether a kid was going to go to college or not. College is becoming more common these days. But I think it became really powerful after Secure Act 2.0, where starting now in 2024, you're not only going to have the option to roll that 529 into an eligible relative, like a sibling or a step sibling or someone, but you'll actually have the power to roll up to 35,000 of that into a Roth account. So God forbid you have too much money saved, which I think we would never say that's really the case, but if you don't use the entire 529 plan, you'll actually be able to roll up to 35,000 of that into a Roth account as well. So it's really nice that not only do you no longer have to pass it just to another child, even though, or a sibling or a relative of some sort, you'll have the option to actually set that designated beneficiary up from the start with a $35,000 tax-free retirement account, giving them a nice head start for a college grad. So we think that really adds to the benefits that 529s already had. So yeah, and then kind of kicking off that topic, it kind of really goes into the planning topic of the typical person that we see, kind of an average family, two kids, eventually need to go to college. What kind of advice would you give a family like that, John, just planning for college and
Yeah, I
trying?
know you've heard this many a time, and having been through it myself, and you will not find another financial advisor in the country who doesn't agree with us that you should save for your retirement first. I'm going to repeat that: save for your retirement first. Way too often people want to they want to do the right thing and open up that 529 and pump all their disposable income into that so they can get 200, $300,000 saved by the time the kid is 18 years old. That is a big mistake. Open the 529, absolutely. Open the UTMA, absolutely. And then when the kid's got enough clothes, you tell the relatives, hey, he's got enough clothes. If you want, you can put the money in the 529. We used to give the slips to our relatives and they would put the $50 or $100 in there. So we didn't overfund 529s. By the time the kids get to college, if you're maxing out your 401k, now you got $1 million, your retirement's secure, and the kids got a few $1,000s each in their 529s, that'll help. But the universities will notoriously punish you if you loaded up your college savings accounts. So now you get there, you got $250,000 in 529. The university says, thank you, send it in. And now they get out of school, they're broke, the kid. You're broke because you didn't save for retirement, you saved for the kid's education. So it's a big mistake. So I really think that you got to max out the retirement plan first. And pretty much, I have never met an advisor that doesn't agree with that. It's just the right thing. And if you Google it, you'll find out that that's always pay your retirement first. You'll get better treatment. Um, Taylor, I think that it goes hand in hand with how you get the financial aid and student loans as well by not having
Yeah,
that much.
I think that that's a big point is that the FAFSA is a name you'll hear a lot when you're starting to think about college, and they have a couple different things which have changed recently. One of the facts is multiple kids now aren't necessarily going to give you a straight up discount off the expected family contribution the way it used to. That was a big change that's came recently. And then the other point of that is the expected family contribution, the amount that your family is expected to contribute. And you touched on it a little bit, but I think it's really important to actually put numbers to the facts with that situation. Whereas if it's a parental asset, the expected family contribution is going to calculate that in about 5.64% of it. So if you had $1 million, you're not expected to contribute the whole amount, only about $56,000 or so. Whereas if the kid had $1 million, which I know is kind of a stretch, but just for theory, $500,000 would be expected. It's a 50% of their assets are expected to be contributed according to the expected family contribution. So really the way it's set up is to punish assets for being in the kid's name. And that is the case for 529s will be counted as 50% of the assets, universal transfer to minor accounts, any funds in their bank. So it really behooves you to save for your retirement first, just like John was saying. It doesn't make as much sense. If you have extra funds, great, absolutely. Throw it into the 529, throw it into an UTMA account. 529s are great because of reasons we said with the transferability and the fact that you can use them with a tax benefit to pay for college. So it's more of a secondary planning tool in our opinion, rather than put all the money in the day you have a kid and start saving as much as possible there. It's more of a, if your retirement's covered, it's a great tool to start using.
Good, good tell. So, one of the questions we're getting bombarded with now is, what about student loan debt forgiveness? Should I take out student loans now? Should I go to school just so this debt can be forgiven? I know it's calmed down a little bit in the last couple of months, the conversation, but what kind of insight can you give us on that?
Yeah, so this is something that I see quite a bit in my generation. I'm somebody that paid off my student loans. I did not want to have them hanging over my head when I had debt to income ratios to purchase a house and all of that. So it was something that I paid off aggressively while I was still living out in Arizona and had a much cheaper living situation than I do now. So it was something I didn't want to have hanging over my head. Not everyone in my generation feels the same about that. I think a lot of the people stick their handouts and say, hey, if it's going to happen, it's going to happen. I know a lot of people that have paid it off that are regretful that they paid it all off, hoping that they get some of it back at some point. But I think when it comes down to it, the big thing is understanding nothing is free. So as much as I don't think that people would want doctors who are making well into the six figures to have some of their student loans forgiven, I think that's part of where the picture comes a little clearer, is that most of the student loans that are out there to be forgiven are in the hands of doctors and other professionals that have advanced degrees, and that a lot of the student loans that are out there that would be forgiven are going to get paid for by everyone, people that didn't go to college. So I think when it comes down to it, it's just really about understanding where the money comes from. Nothing is more expensive than free. So if you're getting free money, understanding that it does still come from the taxpayers, it cuts into the deficit that we have every single year, that it makes it even larger than what it already is. So I think just understanding nothing is free and somebody pays for it. And even if that's not you, it might not make the most sense economically always. So
Good.
awesome. I think we have one last topic before we sign off here, is really just insights on scholarships. And I think that my opinion on scholarships has always been it's found money. Don't count on them. A lot of people will come in, they have children that are straight A students that play a sport, play an instrument, and it's all great, but it's a competitive world out there and you never know what you're going to get. So if you don't count on them as part of the plan, anything you have is found money, and it's something that will just be icing on the cake. But with the way the environment is, I say try to get as many as you can. There's tons out there, plenty to look for, but just don't count on it because you never know what's going to happen. There's so many variables along the way, and it's a very competitive environment. So don't make that your only plan. That's just planning to fail. You have any insight to add to that, John?
No, I don't. I think you covered it well. We'd like to keep these short so they're digestible. There's something that we encourage you to pass on to a friend or somebody that might benefit from hearing it. I know when I listen to these podcasts, if I'm on a treadmill or a stationary bike, I get done, when I listen to a 15-minute podcast, and that's an extra 15 minutes of workout I forgot about. Like I wasn't focusing on the clock ticking on the workout. So I hope this helps you through your day, and I'll end you with a positive thought from Yogi Berra. 90% of this game is half mental. So maybe we'll have some more yogi comments at future podcasts. So thank you for joining us. And if you have any questions, reach out to Taylor or myself.
John Parrillo and Taylor Parrillo are financial advisors offering securities through Cetera Advisors LLC, a registered broker-dealer, doing insurance business in California as CFGA Insurance Agency LLC, member FINRA/SIPC. Advisory services offered through Cetera Investment Advisors LLC, a registered investment advisor. Cetera firms are under separate ownerships from any other named entity. California insurance licenses number 0F60123 and 0M90666, 6265 Greenwich Drive, Suite 251, San Diego, California 92122. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisors LLC. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisors LLC nor any of its representatives may give legal or tax advice. Investors should consider the investment objectives, risks, charges, and expenses associated with municipal fund securities before investing. This information is found in the issuer's official statement and should be read carefully before investing. Investors should also consider whether the investor's or beneficiary's home state offers any state tax or other benefits available only from that state's 529 plan. Any state-based benefit should be one of many appropriately weighed factors in making an investment decision. The The investor should consult their financial or tax advisor before investing in any state's 529 plan. Investors should consider the investment objectives, risks, and charges and expenses of the funds carefully before investing. The prospectus contains this and other information about the funds. Contact John or Taylor Parrillo to obtain a prospectus, which should be read carefully before investing or sending money. A Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for the tax-free and penalty-free withdrawal or earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59 and a half, or due to death, disability, or first-time home purchase, up to a $10,000 lifetime maximum. Depending on state law, Roth IRA distributions may be subject to state taxes.